In Chapter 1 of Macroeconomics, we're going to start at the very beginning with introducing and defining economics, and we'll also look at some preliminary terminology. Here is a recap of everything we're going to learn in this chapter. So we're actually going to start by looking at the definition of economics, and then we're going to go over what the chapter calls the economic perspective. That's just some basic terms and ideas that are true throughout economics that we're actually going to see over and over again throughout both of the two courses. Both macroeconomics and microeconomics use these concepts that we're going to review. I've used the terms micro and macroeconomics already. If you don't know the difference between the two, we're going to talk about that in this chapter. And then the main part of this chapter is looking at what we call the economizing problem. Now, don't get confused because there's actually two ways to look at the economizing problem. They're very similar, but one is the perspective from an individual, one is a perspective from society. And we're also going to be building two models, and the models are just graphs. So the first graph is called the budget line, and that's going to relate to the individual's economizing problem and just help us to understand it a little bit better. And then the other model is called the production possibilities model, or you'll hear me call it the production possibilities curve because it is actually a curve in real life. And that will help us to explain society's economizing problem. We're actually going to spend a good amount of time on this production possibilities model, and it will show back up again in a couple of chapters when we do international trade. So very first step, let's get a good definition of economics. So make sure you know this definition of economics. There's not a lot of definitions I will expect you to memorize in this course, but this is one of the few. So economics is a social science concerned with making optimal choices under conditions of scarcity. So it's a social science, a lot like history or psychology or sociology, but there's actually a lot more real science and real math behind it. So we're going to do a lot of graphing and theory and calculating in this course. Now the keywords, there's actually two keywords in here. The main thing that economics studies is scarcity. And this, you probably know this word. Scarcity just means limited. Okay, so there's less resources than we would want. Okay, so there's a set amount of resources that we can use as a society. And we will actually dig into what I mean by resources a little bit later. You'll see what those are. Or if we're looking at an individual, like you have a limited amount of income, and then you have to decide what to do with it. So we're faced with scarcity, either as individuals or society as a whole, and then economics studies the choices that we have to make because of the scarcity. So your other key word here is the word choices. And this is really the way I like to explain economics. It's all about decision making. It's all about the choices that we're going to make. Now, the next part down here, you will want to know society's economizing problem. As a whole economy, so as a whole, the United States has a problem in the fact that we have scarce resources. So we have a limited amount of resources to use. We have a certain amount of land, we have a certain amount of workers available, but we have unlimited wants. Even if we got everything we wanted, we would want more. So we have to figure out how do we use the resources to get certain things that we want. So make sure you highlight this part. The society's economizing problem is limited resources and unlimited wants. And keep an eye out later because we're going to see the individual's economizing problem when we get to the budget line later on. Now we're going to look into the economic perspective. Basically, these are just concepts that we're going to see show up throughout economics and all through this course. There's 4 different things we'll talk about. I have already talked about the first one, scarcity and choice, opportunity cost, utility, and marginal analysis. We actually have a slide for each one of these, so we'll go into more depth here in a second. So let's go into scarcity and choice a little bit deeper. Like I said, these are your two key words in economics, or in the definition of economics. So we know our resources are scarce, they're limited, we only have a set amount of them, and then we have to make choices based on the fact that we have limited resources. Now, big piece of this that you want to know is opportunity cost. So I gave you the definition here. Opportunity cost is the value of what must be given up to obtain something. Now, keep in mind here, cost in economics is actually a little bit different than the word cost in the way that you would use it in the real world, or the way that you would use it in some of your other business classes. So a lot of times when you're thinking about the cost of something, you're thinking, okay, what did I pay for it? So the cost of a pizza is the $10 that actually came out of my bank account to pay for the pizza. But in economics, we consider not just that explicit cost, the amount that you paid for it, but we also count anything else that you gave up to get that product. So maybe it took you some time to go pick up the pizza. Maybe you decided to have pizza instead of having something else for dinner. It cost you gas to get there to pick up the pizza, or if you paid a delivery driver, we would count that as well. So the opportunity cost would be everything else that you gave up, not just the price of the pizza. So keep that in mind as we move forward. Cost in economics is always greater because we're looking at everything that we gave up to get the product, not just the price. Let me give you another example. If you're thinking about your opportunity cost of going to college, it would include some explicit costs, some things that you actually paid for, like tuition or books or school supplies. It also would include anything else that you gave up to be able to go to school. So school can take a lot of your time. Maybe you would have had a full-time job where you were working and earning income, but instead you're going to school. So all of that income that you would have been making, we actually call those foregone wages. Those get included in your opportunity cost. You may want to jot down the word foregone. Foregone always means a lost opportunity, and it always gets included in our opportunity cost. Okay, the phrase, "there is no free lunch," is actually a famous economics saying, and if you haven't heard it already, you will one day. You'll hear the phrase, "there's no free lunch." All that means is that there's always an opportunity cost. So even if you get something for free, like lunch, those free products that you didn't have to actually pay out of pocket for are using up some resources in the economy. So someone paid for you to have that free lunch, or they gave you the free lunch instead of producing a product that they actually could have sold. So there's some foregone income there that they could have received, but instead they're providing this product to you for free. So there's always going to be an opportunity cost, even if there's not an explicit cost. Next part of our economic perspective is the idea of purposeful behavior. What this means, as economists, since we're studying choices and decisions that people are making, we have to assume that people are acting rationally. So when someone is acting rationally, it means that they're acting in their self-interest. So they're making decisions that will make them better off, not worse off. Now be careful. It doesn't mean the same thing as selfishness. So we would expect someone who's purchasing a product for themselves that makes them happier, that's considered rational, but also someone who is giving away money to a charity, that's also considered rational. So it's not the same as selfishness. It just means that you look for and you pursue opportunities that increase your well-being. Specifically, that increase your utility. Utility is an economics definition. Utility is just the pleasure or satisfaction that you get from consuming a good or service. We use the word consume a lot in economics. Just realize that means something a little bit different than what it means outside of economics. Consume normally means to eat, but in economics, consume just means to use. So I can consume a bicycle. It just means that I bought it and now I'm using it. So keep in mind the word utility. My favorite way to describe utility is happiness. So if individuals are acting rationally, then they're trying to increase their happiness level or their utility. We also expect firms to act rationally by trying to maximize their profit. We will be calculating profit a little bit, but not until the next chapter, but I put the formula on here for you so you would get an idea of what it means. So profit is how much money that the firm has left over after it's already paid all of its costs. So you take the total revenue, and revenue is the amount of money that the firm brings in from selling their product, subtract all of the costs, including the opportunity cost, and you're left with the firm's profit. So the main goal of firms is to maximize the amount of profit that they're making. The next part of our economic perspective is called marginal analysis. So what we're doing whenever we're making decisions, either individuals or businesses, every time they make a decision, they're weighing the costs and benefits. And they're actually weighing specifically the marginal costs and marginal benefit. So marginal means just right on the edge. So it's, if I'm going to make one more product to sell, how much is it going to cost me to make the product? And then how much benefit am I going to get from selling the product? And if the benefit is greater than the cost, then I'll go ahead and produce and sell that good. We'll also see this from an individual perspective if we want to purchase something. So if I'm looking at purchasing a product, I look at the cost of that product, that would be the marginal cost, and I compare that to the benefit. How much am I going to enjoy using the product or consuming the product? And if the benefit, marginal benefit, outweighs the marginal cost, then I will go ahead and purchase the product. So the rule down here is that if the marginal benefit is greater than the marginal cost, then we would say yes to whatever decision that we're making. Yes, I want to buy the product. Or yes, I want to produce and sell the product. Another thing that's interesting about marginal analysis is we know that individuals think this way. Even though most people don't know the terms marginal cost or marginal benefit, every person who makes a decision is actually weighing these two to decide if they want to go forward with their decision or not. So if you ever hear someone say, that's not worth it, what they're saying is, well, the marginal cost is greater than the marginal benefit, so I'm not going to do that. Now we're moving on from the economic perspective. The next concept is the difference between microeconomics and macroeconomics. So microeconomics is the study of individual behavior. So we're going to look at just one consumer or just one firm, or we'll look at just one market. So if there's some products like hamburgers, they're all competing with each other, that would be one market. So just one good that we're studying. And then macroeconomics is the study of the entire economy. A key word to know here is aggregate. Aggregate just means there's lots of little pieces. We're going to add them all up together and then we'll look at them as a whole. So we're looking at an aggregate of the total economy. So some key words to know if you're looking at macroeconomics: you'll see the word total, you'll see the word aggregate, you'll see the word national, or you may see the word domestic. Domestic means within a country, but that means that we're looking at the country as a whole. So here's an activity for you to try. For each one, see if you can figure out if it applies to macroeconomics or microeconomics. So pause the video and give it a shot, and then we'll go over it. Okay, for A, unemployment was 5.2% of the labor force last year. That is macroeconomics. So unemployment is always looking at the nation as a whole. So that's macro. The next one, a study of the trend of pecan prices since the Second World War. That is microeconomics. And we can tell because it's looking at just one market, at just one good. That's pecan prices. Next one, national income grew by 2.7% last year. National income is the income of the whole nation all added together. So that is macroeconomics. Next one, a certain bank increases its interest rates on consumer loans. Since we're looking at just one bank, then that's going to be microeconomics. E, the price of smartphones declined 2.8% last year. This one is microeconomics, and that's because, again, it's just one market. It's the market for smartphones. If we were looking at macro, it would actually be all of the goods added together. So not just smartphones, but literally every single good or service that would be produced in the United States. That would be macroeconomics. And then F, the real domestic output increased by 1.6% last year. Real domestic output is actually what I just described. If they look at all the goods and services in the economy, that add them all up, that's what they call domestic output. So for F, we're looking at the whole economy, then that is macroeconomics. The next distinction we need to make is the difference between a positive economic statement and a normative economic statement. So these are not separate fields of economics. We can be talking about the same concept and give a positive statement and then give a normative statement about that topic. Positive economic statements are statements that are facts. Now, a key thing to remember here is sometimes they're true and sometimes they're false. So what you want to think about is, can I test it? Can I see if it is true or if it is false? And then normative economics are statements that involve value judgments. They're going to sound like opinions. Okay? So you could say, the weather is nice today. That would be a normative statement. Or you could say, the temperature outside is 72 degrees. That would be a positive statement. So here's an activity for you to try. For each statement, decide if it's a positive statement or a normative statement. And then pause the video and we'll go through it here in a second. A, the role of government in the economy should be kept to a minimum. This is a normative statement. This is an opinion. Plenty of people have the opposite of opinion. B, taxes must be reduced for the good of the economy. This is also a normative statement because it's an opinion. C, healthcare accounts for roughly a third of total spending in the economy. This one is a positive statement. We could go see if this is true or not. So we can test it and find out if it's true or false. That's how we can tell if it's positive. B, to help balance the federal budget, Congress increased the tax on gasoline to its highest level in the past 10 years. This is also positive. We can go find out if it's true or if it's false. E, the worsening balance of trade must be corrected if this nation is to remain competitive in the world economy. This is a normative statement as well. Some people think this is true, and some people think that this is false. It is an opinion. So, a few key words to keep in mind. When you're looking for a normative statement, you can look for words like should be. You may see the words ought to, we ought to do something. Or the book likes to use must be, so taxes must be reduced, or the worsening balance of trade must be corrected. And those will fall under normative. With positive statements, there aren't any keywords. It's just going to be something that is a fact, and we can easily find out if it's true or if it's false.